All down. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another episode of Current Market Insights. I'm your host, Ciaran O'Brien, and with me, as always, is my good friend and co-host, Mr. Peter O'Malley.
Hi, Ciaran. Great to see you.
Great to see you, Peter. We also have another special guest with us today, Peter. We have Todd Coleman, who is a mortgage broker from Mortgage Choice Inner West, and we're really excited to have you with us, Todd. Welcome.
Great to be here. Thank you.
Thanks for coming in, Todd. So before we start the conversation, I just want to outlay for our listeners that we are chatting today, Todd, before the Melbourne Cup Day interest rate announcement. And for most of our listeners, you will be listening to this after that, or all of you, in fact. But we are still going to hold pretty firm with what we talked through in the episode, and we're confident that a rate hold is still probably on the cards. If that is different, well, you know, that's life.
It's a shock to everyone.
It's a good problem to have, that's right. So thank you for coming in, Todd. We're really excited to have you here, and we really wanted to spend some time today and just unpick and unpack in many ways for our listeners what is, mortgage broking in a very broad sense, and get an understanding from you of what is, what's the industry like? How is it to engage for our listeners? What's the process? What are the tricks and the tips and all those kinds of things? So hopefully you're ready to go and we can kick off.
Well, mortgage broking, I guess, as an industry in Australia started about 20 odd years ago, partly because banks started to reduce the number of bank managers that they had back then, and that has progressed ever since. An accountant explained to their client that I was basically their new bank manager, and I think that's probably a good way to look at a mortgage broker. Instead of one bank behind us, there's 35, 40 odd banks behind that we can use. And so your mortgage broker becomes the intermediary between you and all of those banks behind, because much like if you go into a Ford to buy a car and you actually want a Holden, Ford's never going to tell you to go to the Holden dealership. Similar with a bank. So if you come to us, we look at the best bank for the client. If you go to the bank, you get the product that they have, whether it suits you or not.
Okay, so one of the major benefits to brokers is, as you say, that kind of unfettered access to a much larger pool of money. Do you, or is there any tendency within the industry, not necessarily just within your business per se, but is there any tendency in the industry to favour particular lenders? Do you have favourites that you like working with, or do you find some that are easier, or what motivates you to necessarily preference one lender over another?
Well, that's a good question, and in the past there was probably a perceived conflict of interest. That's been done away with. Best interest duties were introduced. So there is an obligation for a mortgage broker to actually go through the process to find out what is the best for the client, not what is best for the bank or the mortgage broker. And sometimes that can mean that you're effectively working for free because you're doing something that's not going to generate any income to you, but it's the best interest of the client.
Okay, so those changes were fairly recent. Are they off the back of the Royal Commission a couple of years ago? Is that correct?
Effectively, they are. And the reason, though, that I actually started with Mortgage Choice, that Mortgage Choice had an inherent process to sort of get rid of that conflict of interest anyway. So we just follow that same process that we had, which basically is best interest duty. Okay,
so you're operating in the best interest of the client. And as you say, there are scenarios where you take your responsibility to them seriously enough to preference their need over business need or whatever it might be. Other than having great support and someone who knows the system well, are there interest rate benefits to going through someone like yourself as opposed to direct to a major lender?
Yeah, that's a good question. And yes, there is. Sometimes you can know what's coming up. Lenders will generally never say that, yes, there's going to be a rate drop, or, yeah, look, we're going to be doing a special discount or that sort of thing. But you can be going in and arguing the case for a better rate for a client. I'll give you an example. I had first home buyer we had a pre-approval from a particular bank. When he found his property, we went back and said, look, he's got a better offer from this other bank. Can you match it? They went away. They came back and said, yes, we'll match it. Now, if he'd just gone with that other bank, he would have ended up with a higher rate than what he's now on. So,
yeah, that's a great outcome. I guess the other questions I have around that kind of scenario is not only negotiating better rates for your clients, but is there benefits or do you find better success rates in actually obtaining lending if you do go through a broker as opposed to direct to a major lender?
I can only talk from my experience. So, yes, we generally find that 95 times out of 100 you're going to get a loan for somebody. It may mean that you actually end up having to go to another lender to get that loan, but that's my job, is to make sure that I'm taking that person to the right bank for them. And that's going to depend on different scenarios, whether they're self-employed, how long they've been employed, if they're in a role, whether they're casual, how did they get their deposit for their property, all of those things that we have to weigh up to figure out what is the best bank for them.
Todd, what interest rate should we be paying on our home loans at the moment?
It's the $1 million question. Unfortunately, it does depend on a few things. It will depend on whether you're looking at principal and interest repayments, interest-only repayments, whether it's an owner-occupier or whether it's an investment loan. But generally, if you're an owner-occupier, you should be very low sixes.
Yeah, right. So is there anyone offering in the fives at the moment?
There are some options if you're looking at something like solar panels or green loans. There's some really good deals on those that are in the high fives.
So Todd, when the bank charges investors a higher rate than owner-occupiers, I know they're probably justifying that through a risk component or a perceived risk component. And I don't want you to necessarily throw stones where it's unjustified, but is that a form of price gouging?
Banks will always price based on risk. So they, as you say, that perceived risk is higher for an investor because maybe the rental return doesn't come through. And it's why when you see commercial rents...
Sorry, just on that point, you would suspect that the risk with an investment in some ways would be lower because it's got independent income underpinning it, as opposed to a home loan, which is quite often subject to one person's earnings in many households. So it could be argued, I would argue that in some ways, a home loan, a big home loan to an individual who has to go to work would be riskier.
And that's why some of the banks will actually do what they call a combo. So they'll do owner-occupier and investor at the same rate. So that's always something to look out for people who are in that situation. But a lot of things happen in banking because that's the way it's always been. And it might not necessarily have a good business case as to why they do some of these things, but their policies have been based on something that's been around for a long time. When you challenge the policies, often people can't explain why the policy is there. It's just the way it is.
So we've seen disruptors in this space. The Athena model, let's talk about that, for example. Do you want to give the listeners who might not be familiar with it an understanding of what the Athena model is?
And just to disclose, because Mortgage Choice does actually have a white label offering of Athena, so we do actually use Athena as a product. So the Athena model is they're a tech-based bank, so they can run at a lower cost. Their model is that as the loan to value ratio reduces, that your interest will also reduce. The interest rate will also reduce. So there's an inbuilt way of lowering your lending costs over time. But also they don't have the upfront fees like the application fees, the settlement fees, things like that. So their model is much more client focused.
And has it taken off in the marketplace, or is it something that's struggling to get a foothold? The advertising's pretty aggressive, but how's it performing?
Get good traction. I can't speak for what their volumes exactly are, but I know when I look at them as an option for a lot of lenders, it does become quite compelling to use them.
I must be not getting the advertising. I don't think I've ever heard of an Athena model. But, I mean, that seems like a logical...
It is a brand, not a model, isn't it?
It is a brand.
It's
yes.
a brand.
Yeah. I mean, just hearing the description sounds like a great concept. I mean, as a consumer, that sounds like a great way to do business. Encourage me to pay it down and reward me for doing so. Is exactly. That style, not just Athena, but I guess tech banks and online banks, we've seen a bit of a revolution in that space over the last, say, 5 to 7 years anyway. Do you find that a lot more of your lenders that you deal with, are they starting or have they already kind of transitioned their business model to be lower overhead, sort of more digitally focused without, worrying so much about the consumer interaction component?
Well, I think if you look at some of those fintechs that have come through and then been purchased by big banks as well, if you look at 86400, which was a fintech, was purchased by NAB, and it's now their UBank model. So the big banks do see it as a viable business model and one that consumers are willing to take as well. And consumers have become much more adept at using apps. Most people will do banking now just on the apps. I don't think a lot of people sit at a desktop and log in anymore. And that's evident too when I'm speaking to people. They can pull up information literally while we're sitting there talking as to what their send me screenshots and that sort of thing, so they can tell me the balance, what the interest rate is, all of that information. That was stuff you had to go and pull paper out of a filing cabinet for.
Yeah, I must admit, I'm not surprised to see the transition. I mean, it is so much easier. Being honest, I probably couldn't even tell you what my bank client ID is. It's been logged into an app for so many years now, I wouldn't even have a clue. I wonder with banks like, as you mentioned, UBank's a great example where it's been completely gobbled up by a major lender. Do you think that the average consumer's appetite for just digital banking generally, not necessarily just app-based, but do you think that their appetite to move away from the major banks and that sort of archaic view of banking is becoming more prevalent? And when you are meeting with clients, do you find that they're coming armed potentially with a preference for like a lender or a style of lender as opposed to, maybe some time ago where they just turn up and say, hey, we want to get a house, can you help us get some money?
Yeah, I think people now, just with the use of other online functions, people are more willing to use that sort of product offering. I do think as you start to talk to people as well who may be not au fait with like an Athena model or that sort of thing, that you ask how they interact with the bank, people start to realise that they don't need to go to a branch. They don't need to call a call centre. They'd actually rather do it by sending a request on the app and asking for a rate review on the app. And so when you start to explain to them what their options are, they'll start to look at those sorts of things.
Todd, the median house price in Sydney is around 1.4 million. Have we got a sense of what the sort of average mortgage in Sydney is?
It's just under 800,000.
Okay. So people are geared to the tune of about 60%.
Yeah, and it depends on the areas. Obviously, being in the inner west, we have probably, in some respects, we have a larger price. So the median price in the inner west is probably a bit higher than that. I'd hazard to guess the median loan in the inner west is higher than the 780,000. Yeah. Yeah,
indeed. And you've told us already today that for a home loan, we should be looking for a mortgage rate in the sixes. During COVID, mortgage rates, the lowest I heard, I think, from memory was 1.89. Did you see?
That'd be about right.
Did you see any lower than that?
No, that was, look, if you can get 1.89, it was great.
Yeah.
1.9s and below 2s were
I heard lots of 199s and 2.09. So that's about where mortgage rates bottomed. So they've tripled, everyone except more than tripled in some cases. But the mortgage cliff that many feared didn't eventuate. Again, without breaking any confidences, but you do look at people's finances. Why and how did we avoid the calamity of the mortgage cliff?
Yeah, I think there was a few things. People didn't have the ability to spend money during that period of time. So people were able to increase their savings. People used offset accounts quite well. So people did have an ability that when the rates did go up, that they could make those payments at the higher rate. I think there were some people, unfortunately, that were in over their head, and they did either have to go on to, some sort of ask for some forgiveness from the bank, and some people did have to sell, but definitely it was never going to be.
What does ask for forgiveness mean?
Just asking for a holiday to, like a 6-month period of no repayments or minimum repayments.
You took me back to my Catholic childhood there, Todd.
So we should all ask.
It's something you'd be very familiar with, I think, Peter, asking for forgiveness in Catholic school.
Exactly.
Yeah, so asking for forgiveness with the bank is what?
Yeah, so just effectively going in and asking, can we put a hold on the repayments for 6 months, or can we just do interest only for 6 months? So there was a number of options for people.
And the banks were and are flexible in that regard?
Yeah, because the banks are sitting on a situation where if they do push someone to keep making those repayments and then they do have to go to a mortgagee sale, they're probably not going to get as much back as what they could if that person can get over that hump. Now, it does depend on the situation. It might be that the person had a business and the business was having to sort of trade out of problems. May have been somebody was off work for a period. So it does come down to an individual situation.
Yeah, but is that the driver for the bank? Are they acting with a conscience, or are they acting with this is not good commercial sense to send this person, this customer, into mortgagee in possession, so let's just nurse them out of it and play the long game? Or is this lessons from previous downturns and they've, in their mind, got a new and better way to handle the situation?
Well, I think in each case they look at the individual business cases, to be harsh, but they don't want to also have that reputational issue coming through to say that they're pushing people out of their houses. So if they can see a way out for that person, they're probably going to give them that time to get through that.
And is there a from a recent historical perspective, is there an appetite for home lending at the moment, or are you seeing it? Are you seeing the numbers tightening up?
I'll give you an example. This is one I was looking at yesterday. So the process that I will go through is identify the person's financials, put it into our system and look at all of the different lenders that are out there. These people were probably looking at a loan of about 1.3 was the maximum they wanted. Now, across 35 lenders, I could get up to 1.5 or down to 700,000. So, yeah, in that respect, some people have got a good appetite and others are very risk averse at the minute. So, yeah. But there is still the ability to borrow money if you've got the
and what about new loan starts? Like, what's inquiry like for people looking to come into the market?
Yeah, still a lot of first home buyers interested.
Yep.
Definitely. Obviously, you would know we go through these waves of investors or first home buyers. It is a bit of a mix, but I think there's more first home buyers to investors at the minute.
Yeah, that would be our experience on the ground. Yeah, I showed a good apartment this morning in Glebe, and it was first home buyers over investors, which was good to see. It was an apartment that would draw a really healthy rent, and the tenants of such properties have probably decided, well, if I'm paying that much in rent, and mum and dad are happy to help me into the property market, or they've managed to save a deposit of their own volition, why not get into the property market now?
And that's sort of what I'm seeing is people who are spending X dollars on rent and they're asking how much could I actually borrow. Often they're amazed at what they can actually afford to go and get. Often, unfortunately, the issue comes down to deposit. Some people just haven't been able to save that deposit, and that's where some of the things like, as you say, Peter, with looking at family guarantees. But the other thing is there's a few lenders out there now that are going up to 85% loan-to-value ratio before lender's mortgage insurance comes in. So that's a great help for first home buyers as well.
To get started, yeah.
Exactly, yeah.
Todd, the money markets as we speak have the first rate hike not fully priced in until July 2025. That would be a very, very long 8 to 9 months for a lot of people. When do you think they will cut interest rates?
How long is a piece of string? It changes. Unfortunately, it will change, and it always does. If you look at the big four banks, they've all got predictions of February. other forecasters have got for later in the year as well. But we're also coming into a period at the minute of Black Friday sales, Christmas. That's going to impact the amount of spending that happens. We've got an election in the US. What's the result? It seems pretty knife-edged. Nobody knows. And you've got budgets just come out in the UK. That's going to have some impacts, not as much as probably the US election. But there's a lot of things that are still up in the air. And unfortunately, these things do change.
So when are they going to cut interest rates, Todd?
I'm glad you asked, because I was never going to let him off the hook. I'll come back to that.
Yeah, it'll change frequently between now and when it does happen. But look, you've only got to look back to Philip Lowe when he made that, the bold prediction that interest rates wouldn't change, and unfortunately they did. And that's the problem, is that economic information will flow through, and that will change things. So if I knew when the interest rates were going to change, I'd be a very rich man.
Yeah, so all four retail banks are predicting a rate cut in February. I think that's kind of interesting, or really interesting, from the degree that they know what the consumer's tolerance is, if you like. And then the money markets, probably due to the government spending in the economy and the immigration policy, have taken the view that due to more macro issues, inflation will stay higher. So the retail banks and the money markets are seeing something slightly different, aren't they?
Yeah, exactly right. And if you look at, you mentioned with the inflation figures, the other important thing is some of that government spending has helped to reduce that inflation figure. So if you look at the core figure, it's still up above 3%. How long will that take to come through? I guess that's the thing. They're sort of really hoping that it will not get pushed up through that Christmas period, and come the beginning of next year when the RBA meet, they can have some certainty around that inflation is within the band.
That's contained, yeah.
We've spoken about a lot of things, Todd, and you've given some good insights. One of the things that you touched on just earlier was the rise, in your experience, of first home buyers coming to market at the moment, or looking to get lending. One of the things I'd really like to get out of this episode is, I guess, a bit of an abbreviated, without giving away trade secrets or the need to come and see you, but an abbreviated sense of what are some steps that first home buyers can take to just get themselves into the process more efficiently, I guess. And drawing back very briefly onto a point you made about people paying the rent and getting a deposit together, if you can give any insight, because I know this is a popular question, or it's a common bemoanment of people in the market, is, are there lenders out there that are actually taking into consideration people's rental capacity as a measure of ability to service any lending?
I'll go to the second question first, because yes, they do. So the rent obviously is going to cease once somebody does get into their new property, so that therefore that does come back and include as an input into their income, and will help service the loan. As far as what sort of things should people be looking at to do when they are starting to look for a property, is one, start early. So start to look at your spending patterns. Banks will want to look at what people are spending. They just, whether it's asking for statements or that sort of thing, but there is still a process that they will go through and look at how much people are spending. So start to review that. Often when I do sit with people and we sort of I say, well, how much are you spending? And I might say $2,000 a month, and you go, look at the statements, and you go, do you know you spend $2,000 a month just on Uber? And they're like, oh, yeah. So it's actually a good process for people to start to understand what they are actually spending, and then what they can afford to live on. Some of the other things will be starting to get a savings plan in and start to actually having regular amounts going in on a fortnightly, weekly, monthly basis, so that's starting to increase over time. And it's not always just going to be a ring me on Monday, go to auction on Saturday. Sometimes I've had people where I've spent 2 years with, because it's just getting them through understanding what the serviceability is, starting to look for properties, starting to get a savings plan, starting to talk to family about family guarantees and those sorts of things. So it's not always just going to be start now and buy a property next week.
Is there it's a hard question, but is there an average kind of time frame you would advise? If someone's listening today saying, you know what, we think we're ready, how much lead time would you recommend as a kind of minimum just to make sure they're all squared away come purchase day?
Look, if people have been starting to get some of those things in place, and they've got good income and good serviceability, and they have been watching their spending, there's no reason why it shouldn't be a matter of, weeks, a month. People can do it in that sort of time frame. If the other really important thing, though, and you guys would sort of see this more than I would, but what does the person actually want in their new property? And having that list of what sort of things they have to have in a property and what are their needs and wants, I guess, in that property as well.
Is there, in your experience, so for first-time buyers, because we obviously see trends in the market in terms of not only what types of buyers are around, but particularly what in property is doing well at any given time, talking about things that they're looking for. Is there a difference in appetite amongst the lenders based on the types of property that these people are looking for? Or is it purely based on value, valuation? It's
still pretty much valuation. There's, small properties, that you're under 40 square metres. Obviously, that's a harder one to get across. There are a few lenders that will look at them, but it's a bit harder to get through because, if I look at a normal situation, 2-bedroom, 80 square metres, that sort of thing, and it's 35 lenders I can look at, whereas 40 square metres you might be down to 3 or 4 lenders, so just maybe not going to get as good a deal.
This one might be a hard question for you, but drawing back to the situation we have where some of these lenders are coming that aren't, as you say, you've got 35 that you have access to, and we're used to in Australia, arbitrarily 4 big banks that we borrow from. Thinking I say very far back, but not that far ago to the GFC, for example, and all the issues the American banks faced with their, not that we're in the same situation at all, but can consumers here in Australia feel comfortable or can they feel assured that these newer lenders that aren't well established necessarily in our market have the same backups and protections in the event that something does go wrong in the market?
If I look at that panel of 35, they're not all banks. Some are non-bank lenders as well, so that's an important distinction. But a bank, whether it's a Big Four or whether it's a ABC bank, are all regulated under the same regulations from APRA. They all have the same bank guarantee from a government perspective. So a bank is a bank. The non-bank lenders will have similar processes in place, but they don't have that same regulatory backing that the banks do.
Okay, so there is still some risk there. Look, really, really great discussion today, Todd. I know myself and Peter are very thankful that you've come on in. It is a complex topic, lending. It's something that we understand at a cursory level, but certainly don't understand as experts like yourself. If anyone is listening and does need some support, what's the best way for people to get in touch with you?
Check out my website, which is just look at Mortgage Choice, Todd Coleman, whether it come through you guys if they're looking for properties. But just check the website.
Perfect. And I'll put Todd's details in the description for the episode today. So if anyone does want to reach out, they certainly can. Once again, Todd, really, really great discussion. Thanks so much for coming in.
Thank you.
Thanks very much, Todd.
And thanks to everyone for listening to Current Market Insights. We look forward to speaking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.